Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, markets have been relatively upbeat again this week. Is this the calm before another storm, or a sign of genuine progress?
It's both. Calm on the surface, but still a lot of undercurrents. Markets cheered the US-UK trade agreement, seeing it as a sign that diplomacy may be making a comeback. There's talk of more deals on the way, and even a weekend meeting between the US and China is being framed as a diplomatic thaw. But let's not get ahead of ourselves. This is an icebreaker, not a breakthrough. What's really driving sentiment is the hope that the worst of the tariff escalation is behind us. The markets want to believe the message more than they trust the substance. And in the absence of fresh shocks, that belief is enough, for now.
Japanese equities have had a remarkable run lately. What's going on there?
Japan's playing catch-up, and playing it well. The main Japanese stock market has now notched 11 consecutive days of gains. After being left behind in earlier rallies, Japanese equities are getting a second win. Yes, growth has been downgraded. Yes, inflation targets have been pushed out. But there's something refreshingly stable about Japan right now. Corporate restructuring continues, the yen remains weak, and investor sentiment is improving. In a market world addicted to momentum, Japan suddenly looks like the steady hand.
On the flip side, U.S. bonds are looking shaky. What's the worry there?
Productivity and wages, it's a toxic mix. We had a nasty cocktail in the latest data. Productivity dropped 0.8%. At the same time, unit labor costs jumped more than expected, up 5.7%. That kind of squeeze, high wages, low output, is not what the bond market wants to see. Yields are starting to creep up again. And remember, this is happening against a backdrop of slowing growth and renewed whispers of tax cuts. The bond market isn't panicking yet, but it's definitely uneasy.
The Fed left rates unchanged this week, but the language seemed more cautious. What stood out to you?
The Fed is finally acknowledging the bind it's in. They're seeing risks on both sides of the mandate. Higher unemployment and higher inflation. That's a rare admission. Usually, one dominates the other. But here's the twist. The labor market may not behave like it used to. With immigration falling sharply, potentially dropping from 2.7 million last year to just 1 million this year, the traditional link between a slowing economy and rising unemployment might be weaker. Fewer workers entering the system means less slack, even as growth softens. So assuming rate cuts will come just because joblessness ticks up, that may be wishful thinking.
We also saw some strong resilience from India this week. What's happening there?
India continues to surprise to the upside. Despite geopolitical tensions, the Nifty 50 has rallied back nearly 10% from its April lows. Over half of the index's companies beat earnings expectations, and the central bank is signaling room to cut rates. Add a tax relief package aimed at middle-income households, and you've got a rare combination: macro stability, fiscal support, and earnings momentum. Investors are paying attention.
That's it for this week. Stay tuned for more insights next time.